this is the topic for today's discussion. What is a coupon and a yield? So as we just studied on the first, when we look in for the structuring of the creation of a bond on the very initial beginning, the rate of interest defined at the time of investment is known as the coupon rate, is the periodic interest payment made by the borrower to the bond investor, and it is expressed in terms of percentage. So 10% becomes the coupon rate, and the coupon rate remains constant throughout the life of a bond for the entire period of 5 years till the duration of the bond is, in our case, an example, the 10% coupon rate will never change. Every year at the rate of 10%, the issuer will pay interest to the bond holder. So coupon rate is the basic percentage of rate of interest which has been defined at the time of creation of an instrument. However, bonds are a tradable instruments. They are listed in the capital market. You can buy and sell bonds, and the price of a bond keeps on changing depending upon various conditions. It can be because of market supply, demand and supply, because of the change in the base interest rates in the market. We've seen in last 1.5 years, there's continuously base rate or the repo rates have been increasingly continuously. So the bond yields, the price of the bond was falling and the yields were rising. So in a sense that the price of a bond keeps on changing during the life cycle of a bond. So what exactly a yield is? So when I invest into a bond in the secondary market, and the rate of interest which I will earn from the date of my investment till the maturity is known as the yield to maturity, or YTM, yield. So yield is just a function of return, the actual return the investor will make from his date of investment till maturity. Now, in our case, let's take with an example. Though the face value of a bond is, for example, is 10 lakh rupees, coupon rate remains 10% only, but the market price of the bond is 9 lakh. So a 10 lakh rupee face value bond, I am buying it at 9 lakh rupees today. So I am buying it at a discounted value. The price of the bond instead of a 10 lakh rupees is 9 lakh rupees. So what essentially it means is my investment is today 9 lakh, but on the maturity, I will still get the face value, which is a 10 lakh rupee. So I have invested less and my maturity amount is more. So what will happen? It means my return is on the higher end side. Now this return from my date of investment till maturity is known as the YTM, or yield to maturity, calculated in the format of an XIRR. You can do an Excel calculation as well, or we have a tool to do this calculation. It is basically coupon rate divided by the market price of the bond. So yield to maturity is the total return the investor will receive if you buy a bond today and hold it to the maturity. In our case, a 10 lakh rupee bond bought at 9 lakh rupees for the same interest payment frequency, if it is following the same, the YTM is 12.82. Though the coupon of the bond is still 10%, my net effective return is much higher. The case can be reversed if the price of the bond is changed. So instead of 10 lakh rupees, I am buying it at 11 lakh rupees. Now what will happen is my yield will low because I have invested a higher amount, whereas the maturity, I will still get the principal amount of, or the face value of the bond. So that will change. So I will discuss in the next slides how the yield and the price movement takes place. But this effective return to in the hands of investor from the date of investment till maturity is known as the yield. So I'm sure that people will now relate to a coupon is a fixed rate of interest which will remain constant to the life cycle of a bond, whereas the yield can change on various market conditions, and yield is the actual return which I'm going to make from the date of investment. We can work it on an Excel formula. You can use an XIRR tool on Excel sheet also to plot the cash flow. A very small cash flow example we have just given it. If I'm investing 9 lakh rupees, so my cost of investment is minus 9 lakh on 31st January 2022. And every year, 23, 24, 25, 26, 27, I am getting principal. So it's plus 1 lakh, 1 lakh, 1 lakh as an interest. And on 31st January 27, I'm getting my 1 lakh interest component and my 10 lakh rupees of a face value of a bond. So my actual IRR or YTM will remain 12.82. So one more important point when investing into a bond, we should keep in mind is whether the bond has a call option or a put option as well. A call option is an option which gives the issuer the right to exercise the call. In a sense, it can call back the bond and make the principal payment to the investor before the maturity date. Hypothetically, the bond is a 10-year duration bond, but the issuer has kept a call option at the end of 5 years. And the issuer has the right to exercise the call, and he can make the principal payment back to the investor. In scenarios when there is a call option in an instrument or a covenant of a call option is there, the yield to maturity is not the correct criteria to calculate the return, because as an investor, I do not know whether the issuer will exercise the call or not. He has the right to exercise, he may or may not, depending upon the market conditions. So when I am calculating my effective returns, I should always calculate yield to call. Instead of calculating the yield till maturity date, I should calculate the yield till the call date. Then you get a clear picture of what returns you are getting. And henceforth, if the call has not been exercised, then you can keep following the principle of yield to maturity if the call date has passed, or how the bond is structured. If the bond has a regular, every year the issuer will have the call option to exercise depending upon how the bond is structured. So this very important component investors should keep in mind when calculating returns for an investment which has a call option or a call duration. So yield to maturity is an instrument which does not have a call option, and you have to calculate till the maturity date. Yield to call for an instrument which has a call option. For an example, given a sub-debt bond of Bank of Punjab National Bank. So this is an old bond which was issued earlier. The maturity date was 2027, whereas it has a call option in the year 2022, November 10th, 2022. So instead of calculating the yield till 27, we should always calculate the yield till 2022. And when we do this calculation, it is known as yield to call and not yield to maturity. Your transaction value or your realization may differ because YTM will have a different function or a different result as compared to YTC. So as an investor, you should always keep in mind, if there is a call option, you should always invest into an instrument, keep taking into consideration that what is the YTC and not YTM. The price and yield of a bond is always inversely related. You can take this spinning wheel as
Ferris wheel.
To always keep this thing in mind, that wheel will help you understand or keep relate to you. The price and yield of a bond is always inversely related. Essentially, a price of a bond, when we structure a bond and whenever we calculate it, we work and say that the par value of a bond is 100 rupees. In example, the face value of a bond is 100 rupees. And it is at 10% coupon rate. So price is 100 rupees, coupon is 10%. Now, during a course of time, the price of the bond has changed and there was more of sellers in the market for a particular bond and less of buyers. What will happen is essentially the price of the bond will fall. It will fall to say 95 rupees. So 95 rupees is when the secondary price when I'm investing into a bond. But what will happen at the maturity? Though I'm investing for a bond at 95 rupees, the maturity value still remains the 100 rupees, and the face value still remains as 100 rupees. Issuer will return 100 rupees only to the investor who's holding the bond. So my investment is 95, but my return is 100, and I'm earning interest component at 10% because that is the coupon rate. So effectively, my return will be higher. So 10% is the coupon rate plus 5 rupees of differential because I have bought it at a bond which is at a discounted price. So my yield will be higher than the coupon rate. So price is low, but my return is higher. So yield is higher when the price is low. Vice versa, the bond is trading at say 105 rupees. What will happen is I invested 105 rupees, but at the maturity, I will get only 100 rupees. Though I'm getting 10% as my coupon, which is defined at the time of investment structuring, but I am investing 105 and at maturity, I am getting 100 rupees. So 5 rupees is the loss which I have incurred. in investment in this bond. Now, effectively, what will happen is my 10% yield will become, say, 9.5%. So my realization on that investment is, instead of 10%, which is the coupon, might be at 9.5%, for an example. So if the price of a bond is higher, then the yield is lower. And if the price of the bond is lower, then the yield is higher. So it is an inversely related in structure. So price and yield are always inversely related. Now, as we discussed, yield, the second best or the alternative for calculating the value of a bond is the price of a bond. So yield and price are inversely related to either you calculate yield of a bond or you calculate a price of a bond to realize your investment will give you how much return. So what is the price of a bond? As we just discussed earlier, we consider par value or 100 rupee as the price of a bond. Whatever the face value may be, 100 rupees is considered as this is a standard, global standard to calculate the price of a bond, 100 rupees or the par value. So whenever a bond is issued, whether it is a 1,000 rupee face value bond, a lakh rupee face value bond, or a crore rupee face value bond, we just, for calculation purpose, 100 becomes a very smaller denomination and becomes easy for anybody to calculate. So 100 rupees is considered as a par value. So when the bond is issued, the price of the bond is 100 rupees. If the coupon rate is 10% and I am an investor who invested in the primary issuance and hold this instrument till maturity, for me the yield, price, coupon all remains static. 100 rupees is the price of the bond. At the maturity, I get 100 rupees into the face value of a bond and number of units I have applied for. 100 rupees is the face value, par value, and the coupon is 10%. And I have not done any trading, or I have not sold the bond. I have not purchased in the market during this life cycle of a bond. So my coupon and yield will also remain constant. So I have no effect in the price or in yield. But suppose I have bought a bond in the secondary market, then what should I pay for that instrument? 100.5 hypothetically is, for the calculation purpose we're taking into consideration. A 10% coupon bond is available at 100.5. So what does it signify? Very immediately, if you look into and say, okay, so 100 rupee is the par value, it is available at 100.5, and the price of the bond is higher. So yield, my net yield will be lower than 10%, and lower than the coupon. So the bond is trading at premium. This is the first thing which is going to immediately signifies to when you see the price of a bond. Now, from the structural, we're saying the settlement interest payment date is every 11th January 2022. It will going to keep making the payment, but I am buying a bond which is an annual interest payment product in mid of the year, say 30th June 2022. I am buying. How will I calculate my effective investments? So I have to take into consideration the issuer is paying interest on an annual basis. Every year, at the end of the year, whosoever is holding the bond in his demat account on the interest payment date, he will receive the interest. Suppose A was the investor initially, and mid of the year, B investor has bought this bond from A investor. On the interest payment date, B is the investor who is holding the bond in his demat account. Issuer will pay the entire 1 year interest to B in his demat account, because he will pay only on the basis of who is holding the bond, and from the last interest payment date to the current, he will pay the. But A was the one who was holding the bond for the first 6 months. So technically, A is the one who is the rightest owner of that interest component for first 6 months. In our case, the example is for 169 days. So how will you calculate the interest component? Is basically you calculate the accrued interest component and you pay the accrued. So B as an investor will pay that 169 days ka interest to investor A, because that is his component of holding. And at the end of next interest payment cycle, the investor B will receive the entire interest for that duration. This is also a part of your calculation. This component is known as accrued interest, and it determines the settlement value. So when I am buying a bond, accrued interest component in our case is 10% into 100, the par value. 169 by 365. So number of days, because I was holding 169 days, you calculate 1 day interest and then 169 by 365. So 4.63 is the interest component, accrued interest component. For in our case, 100 rupee bond, 10% interest component, yani ki at the end of next interest payment, the issuer will pay 10 rupees of interest. Out of 10 rupees, 4.63 is the interest component which is for investor A, and investor B will earn the remaining component. So when he's buying a bond, his dirty price is the price of a bond 100.5 plus 4.63. When I'm paying the amount, I'm paying 105.13 as the dirty price. This accrued interest component of 4.63, which I'm paying upfront right now to investor A because I'm buying from him, will be credited back to my account. 4.63 will come back to my account at the end of the next interest payment date. I will get 10 rupees in interest component. So my actual value, I am still paying 100.5 as the price of the bond. But dirty price and clean price, there's a difference into it. Dirty price is 100.5 plus 4.63. Clean price is only 100.5. So the face value, to total consideration amount and a total amount which I have to pay is face value of the bond into price of the bond divided by 100. Dirty price divided by 100. So I am paying 10,51,300 rupees. But for 40,063 rupees, 46,300 rupees will be back to my account as an interest component at the end of the maturity, at the end of interest payment date.
To make life simpler and to make it easy, this is a product that is a revolutionary product that we launched. Again, we don't call it a product. Our whole objective is that it is available. We do not encash this. We are not charging anybody. It is available free for all. The whole objective is to ensure that investors like you and me, individuals who would like to make an investment, it's very difficult in today's day-to-day activity for you to go and create an Excel and then try to do the calculations. And if there's an error, then it can lead to wrong decisions. So to make this simpler and to make more informed decision, what we did as IndiaBonds did is, the first thing before anything is that we launched a revolutionary product called a bond calculator. This is not unlike any normal bond calculator. We have at the back end, we have created an engine that incorporates every aspect of a term sheet. एग्जाम्पल के तौर पे अगर आप टाटा कैपिटल एग्जाम्पल में इन्वेस्ट करना चाहेंगे तो टाटा कैपिटल जब आप सर्च करेंगे तो उनके 10 बॉन्ड मिलते हैं, तो वो 10 बॉन्ड्स के सबके यूनिक ISINs होते हैं and or they have different maturities, they have different characteristics. So at the back end, we have created a whole engine, we have created the whole cash flow, which will take into consideration every aspect of a bond. That is a maturity, a call option, if there is a call date, if there is a holiday, if there is an interest payment, if there is a principal repayment, whether it is part, whether it is full. So we have given the functionality to our customers to empower them to go ahead and use this calculator, and it is free of cost. And it is one of its kind in the whole of India. Let's hypothetically say for right now, look at, there will be new arrivals that will be shown. This would cover almost 5,000 plus ISINs which are currently active. मतलब 5,000 plus bonds हैं. जरूरी नहीं है कि वो bond India bonds पे available हो. हर एक bond जो market में outstanding होता है, we try to ensure that we provide that as a facility. Hence, this is purely to help customers like you and me to make informed decisions. Quickly, let's look at an example. Like Harit said, I'll go into the expand version, so a lot of you who have logged in can be able to see the same. Let's assume that this is the price of a bond. Muthoot Microfinance is the bond that is currently available. It is currently available at, say, 100 rupees. That is at par. It is giving a 10.75 coupon, which is paid on a monthly basis. The yield of the same becomes 11.28. Now, let's assume that you want to tomorrow sell this bond and you have held it for some time. So accrued interest calculation will be a little difficult, but you want to sell it. So you want to know at what price I would want to sell it in the market. Let's assume that you want to sell it at 101 rupee. That is, each bond has been given 100 rupees as the base or the face value. It's very simple. When do you want to sell it? You just choose your date. You can come here, you can choose the settlement date. That is the day when you want to settle this. That means the day when you want to actually transfer the bond or sell the bond. Just click on this, put 101 rupee and click calculate. Here you will get to know that at what yield you are selling in the secondary market. That means you've purchased it at 11.28 hypothetically. You sell it at 101 rupee on 17th of this month. The actual yield, the highlighted yield is the 10.69 at which you have made. So you made a gain between 11.28 to 10.69. This is the effective yield. In case if you want to see, we've just added a permutation combination when it is 10 basis points higher or 10 basis points lower. Depending on that, the price is also given. It is 101 rupee, is 101.1705 and 100.8300. We normally prefer, or we normally give out options in the secondary option in the secondary bond with a 4 decimal because that impacts your yield.